Assalamualaikum and hi everyone. Today, my friends and I will present about the tutorial question number 4, which is related to conceptual framework. But before that, let us introduce ourselves first. My name is Sayyidatina Ummi Kalsum binti Said Umar.
Hi, my name is Nur Ashki binti Muhammad Ali.
My name is Nurhuda binti Jamal.
My name is Siti Nur Nadia binti Ismail.
Before we go further, let's take a look on the question first. So here is the question. Students need to review the Malaysia Conceptual Framework on the MASB website. Prepare a 40 minutes presentation and report the important findings from Malaysia Conceptual Framework. Please also explain the similarities or differences between Malaysia Conceptual Framework and the IASB framework. Firstly, we need to know what is the definition of conceptual framework itself. Conceptual framework is defined as a coherent system of interrelated objectives and fundamentals that is expected to lead to consistent standards and that prescribes the nature, function, limits of financial accounting and reporting. Next, what is the purpose of conceptual framework? Number 1, to assist accounting standard setter in standard setting. It is used to assist MASB in the development of future MFRS and its review of existing MFRS that are based on consistent concepts. Secondly, to assist preparers to develop consistent accounting policy when no standard applies to a particular transaction or other event, or when a standard allows a choice of accounting policy. Next, it assists all parties to understand and interpret the standards. As such, it assists auditors in forming an opinion on whether financial statements comply with MFRS and to assist users of financial statements in interpreting the information contained in financial statements prepared in compliance with MFRS. In addition, the purpose is to facilitate a common understanding of basic principles or concepts of financial reporting among all those users. On the other hand, conceptual framework is a behavioral code that all parties should follow. Now, let's move to the objective of financial report. First and foremost, to provide financial information about the reporting entity that is useful to existing and potential investors, lenders, and other creditors in making decisions about providing resources to the entity. Those decisions involve decisions about buying, selling equity and debt instruments, providing or settling loans and other forms of credit, and more. Next, to help users to make investment decisions, financial reports should provide information that users can consider to judge the performance and effectiveness of the business to help them make investment decisions. Moreover, the objective is to analyze asset, liabilities, and owner's equity. By analyzing this aspect and any changes to them, a company can work out what to expect in the future and what to modify as for the early preparation. This also shows the availability of resources for future growth. Not only that, the objective also includes to track cash flow. This will show how well a business is currently performing and whether it can cover debt and continue to grow. On the other hand, there are a few of usefulness and limitation of general purpose of financial reporting. The first usefulness is to provide high-quality financial reporting information that are primarily financial in nature, useful for economic decision-making. Providing high-quality financial reporting information is important because it will positively influence capital providers and other stakeholders in making investment. Next, it is the best tools of business decision-making by become a pattern detection in the market. Financial statements show the market position where it will be identified based on sales fluctuation from period to period. By this, management can take necessary steps to improve its standard by employing efficient marketing personnel who suggest product sales improvement. Last but not least, it can provide the information to help existing and potential investors, lenders, and other creditors to estimate the value of reporting entity. Now, we move to the limitations of the general purpose financial reporting. General purpose financial reports do not and cannot provide all of the information that existing and potential investors, lenders, and other creditors need. Those users need to consider pertinent information from other resources, for example, general economic conditions and expectation, political event, political climate and industry, and the company outlooks. Next, it is not designed to show the value of reporting entity, where it only shows the estimation, the value of the reporting entity. Furthermore, financial report is based on estimates, judgment, assumption, and models rather than exact depiction. Assumption and judgment are personal and depend on the person making them, and hence they might differ from person to person, and this renders the financial statement analysis vulnerable to incorrect or unreasonable result.
Now, I will explain about qualitative characteristic of useful financial information. This topic discusses to how identify the types of information that are likely to be most useful to the existing and potential investors, lenders, and other creditors for making decisions about the reporting entity based on information in its financial report. Here is the fundamental qualitative characteristic of financial information. The first one is relevant. Relevant financial information can make a difference in the decision made by users, even if some users choose not to take advantage of it or are already aware of it from other sources. Relevant financial information can make a difference in decision if it has predictive value, confirmatory value, or both. Financial information has predictive value if it can be used as an input to process employed by users to predict future outcome. In other hand, financial information has confirmatory value if it provides feedback about previous evaluation. The second one is faithful representation. To be useful, financial information must not only represent relevant phenomena, but it must also faithfully represent the substance of the phenomena that it purports to represent. To be a perfectly faithful representation, a depiction would have three characteristics. It would be complete, neutral, and free from error. A complete depiction includes all information necessary for a user to understand the phenomenon being depicted, including all necessary description and explanation. A neutral depiction is without bias in the selection or presentation of financial information. There is not slanted, weighted, emphasis, de-emphasis, or otherwise manipulated to increase the probability that financial information will be received favorably or unfavorably by users. A free from error means there are no errors or omission in the description of the phenomenon, and the process used to produce the reported information has been selected and applied with no error in the process. In this context, free from error does not mean perfectly accurate in all respects. Next, let's talk about qualitative characteristics that enhance the usefulness of information that both is relevant and provides a faithful representation of what it purports to represent. Number one is comparability. Information about a reporting entity is more useful if it can be compared with similar information about other entities and with similar information about the same entity for another period or another date. It is the qualitative characteristic that enables users to identify and understand similarities in and difference among items. Related to this comparability, the information needs to be consistent. Consistency refers to the use of the same method for the same items, either from period to period within a reporting entity or in a single period across entities. Comparability is the goal. Consistency helps to achieve that goal. Number two is verifiability. Verifiability means that different knowledgeable and independent observers could reach consensus, although not necessarily complete agreement. Verifiability helps assure users that information faithfully represents the economic phenomena it purports to represent. Verification can be direct or indirect. Direct verification means verifying an amount or other representation through direct observation, for example by counting cash. For indirect verification means checking the inputs to a model, formula, or other technique and recalculating the outputs using the same methodology. Number three is timeliness. Timeliness means having information available to decision makers in time to be capable of influencing their decisions. Generally, the less useful is because of the information. Number four is understandability. Classifying, characterizing, and presenting information clearly and concisely make it understandable. Excluding information about those phenomena from financial reports might make the information in those financial reports easier to understand. However, those reports would be incomplete and therefore possibly misleading. Let's move to the cost constraint on useful financial reporting. Cost is a pervasive constraint on the information that can be provided by financial reporting. Reporting financial information imposes costs, and it is important that those costs are justified by the benefits of reporting that information. Provider of financial information expend most of the effort involved in collecting, processing, verifying, and disseminating financial information, but users ultimately bear those costs in the form of reduced return. Users of financial information also incur costs of analyzing and interpreting the information provided. If needed information is not provided, users incur additional costs to obtain that information. When applying the cost constraint in developing a purpose standard, the board seeks information from provider of financial information, users, auditors, academic, and other about the expected nature and quantity of the benefits and costs of the standard. Here, we will discuss about financial statement and the reporting entity. First, the objective of financial statements is to provide financial information about the reporting entity's assets, liabilities, equity, income, and expenses that is useful to users of financial statements in assessing the prospect for future net cash inflow through the reporting entities and in assessing management stewardship of the entity's economic resources. The information provided statement of financial position by recognizing assets, liabilities, and equity, statement of profit or loss by recognizing income and expenses, and in other statement and notes by presenting and disclosing information about recognized assets, liabilities, equities, income and expenses, cash inflow, and etc. Second is reporting period. Financial statements are prepared for a specified period of time and provide information about assets and liabilities, including unrecognized assets and liabilities, and equity that existed at the end of the reporting period or during the reporting period, and income and expenses for the reporting period. It's to help user of financial statements to identify and assess change and trends. Financial statements also provide comparative information for at least one preceding reporting period. Third is perspective adopted in financial statement. Financial statements provide information about transaction and other events viewed from the perspective of the reporting entity as a whole, not from the perspective of any particular group of the entity's existing or potential investor, lenders, or other creditors. Fourth is going concern assumption. Financial statements are often prepared under the assumption that the reporting entity is a going concern that will continue to operate in the near future. As a result, it's assumed that the company doesn't want or need to go into liquidation or stop trading. A reporting entity is an entity that is required or choose to prepare financial statements. A reporting entity can be a single entity or a portion of an entity or can comprise more than one entity. Let's see the types of financial statement. Number 1, consolidated financial statement is reporting entity that comprises both of parent and its subsidiaries. Number 2, unconsolidated financial statement is reporting entity that is the parent alone. The reporting entity financial statement are referred to as. And number 3, combined financial statement is reporting entity that comprises two or more entities that are not all linked by a parent-subsidiary relationship.
Okay, next I will present to you regarding the definition, recognition, derecognition, and measurement of the element in financial statement. Before we move further, let's take a look at the element of financial statement. The element of financial statement can be seen through the complete set of financial statement, which are statement of financial position, income statement, statement of changes in equity, statement of cash flows, and notes to financial statement. All of these statements built up by 5 key elements, which are asset, liability, equity, revenue, and expenses. Now, let's take a look at the definition of each element. First is asset. As mentioned by MASB in its report about conceptual framework, an asset is a present economic resource controlled by the entity as a result of a past event and from which future economic benefits are expected to flow to the entity. Next is liability. It is a present obligation of the entity to transfer an economic resource as a result of past event, the settlement of which is expected to result in an outflow from the entity of the resources embodying economic benefit. Apart from that, equity is the residual interest in the asset of the entity after deducting all of its liability. The next one is income. Increase in economic benefits during the accounting periods in the form of inflows or enhancement of asset or decreases in liabilities that resulted to the increases in equity other than those relating to contribution from holders of equity claims. Last element of financial statement is expenses. Expenses is a decrease in asset or increases in liabilities that result in the decreases in equity other than those relating to distribution to holders of equity claims. Moving further to the recognition of elements. Recognition is a process of incorporating in the balance sheet or income statement an item that meets the definition of an element and satisfy the criteria for recognition, which are it is probably that any future economic benefit associated with the item will flow to or from the entity. For instance, when it is probable that a receivable owed to the entity will be paid, it is justifiable to recognize the receivable as an asset. Other than that, the item has a cost or value that can be measured with reliability. It means the use of estimation in cost or value is an essential part of the preparing financial statement, and it does not undermine the reliability of the cost itself. Now, let's take a look at the recognition of each element. For asset, it is recognized when it is probable that the future economic benefits will flow to the entity and the asset has a cost or value that can be measured reliably. An asset is not recognized in the balance sheet when expenditure has been incurred for which it is considered improbable that economic benefits will flow to the entity beyond the current accounting period. Instead, it will be recognized as an expenses in the income statement. The second one is the recognition of liabilities. Liabilities will be recognized in the balance sheet when it is probable that an outflow of resources embodying economic benefits will result from the settlement of the present obligation, and the amount at which the settlement will take place can be measured reliably. The third one is income. Income can be recognized in the income statement when an increase in future economic benefits related to an increase in asset or decrease of that liability can be measured reliably. The fourth one is expenses. Expenses can be recognized in the income statement when a decrease in future economic benefits related to a decrease in asset or increased liability can be measured reliably. Next, let's take a look at the derecognition of financial statement. Derecognition is the removal of all or part of the recognized asset or liability from an entity statement of financial position. Derecognition normally occurs when that item no longer meets the definition of an asset or a liability. As for an asset, derecognition normally occurs when the entity loses control of all or part of the recognized asset. Meanwhile, for the liability, derecognition normally occurs when the entity no longer has a present obligation for all or part of the recognized liability. Accounting requirements for derecognition aim to faithfully represent both any asset and liabilities retained after the transaction or other event that led to the derecognition, including any asset or liability acquired, incurred, or created as part of the transaction or other event. The change in the entity's asset and liabilities as a result of that transaction or other event. Okay, next. Moving on to the measurement of elements. So what is measurement? It is the process of determining the monetary amounts at which the elements of the financial statement are to be recognized and carried in the balance sheet and income statement. A number of different measurement bases are employed to different degrees and in varying combination in financial statement, including historical cost, current cost, realizable or settlement value, and the present value. As for historical cost, it is whereas assets are recorded at the amount of cash or equivalent paid or fair value of the consideration given during acquisition, while liabilities are recorded at the number of proceeds received in exchange for an obligation. For instance, income taxes are expected to be paid to satisfy the liabilities in the normal course of business. As for the current cost, assets are carried at an amount of cash or equivalent that will have been paid if the same or equivalent asset was acquired currently. Meanwhile, liabilities carried at an undiscounted amount of cash or equivalent that will be required to settle the obligation currently. Next, realizable or settlement value. Assets are carried at the amount of cash or equivalent that could currently be obtained by selling the asset in an orderly disposal, while liabilities carried at their settlement values, the undiscounted amount of cash or equivalent expected to be paid to satisfy the liabilities in the normal course of business. Last one is present value. Asset carried at the present discounted value of the future net cash flows that the item is expected to generate in the normal course of business. Meanwhile, liabilities are carried at the present discounted value of the future net cash outflows that are expected to be required to settle the liabilities in the normal course of business.
Next, we move to the presentation and disclosure of financial reporting. First, presentation and disclosure as communication tools. A reporting entity communicates information about its assets, liabilities, equity, income, and expenses by presenting and disclosing information in its financial statements. Effective communication of information in financial statements requires focusing on presentation and disclosure objectives and principles rather than focusing on rules, classifying information in a manner that groups similar items and separates dissimilar items. Aggregating information in such a way that it is not obscure either by unnecessary detail or by excessive aggregation. Hence, in making decisions about presentation and disclosure, it is important to consider whether benefits provided to users of financial statement by presenting or disclosing particular information are likely to justify the cost of providing and using that information. Next, presentation and disclosure objective and principle. To facilitate effective communication of information in financial statements, when developing presentation and disclosure requirements in standards, a balance is needed between, first, giving entities the flexibility to provide relevant information that faithfully represent entities' assets, liabilities, equity, income, and expenses. Second, requiring information that is comparable both from period to period for a reporting entity and in a single reporting period across entities. On the other hand, presentation and disclosure objectives help entities to identify useful information and decide how to communicate that information in the most effective manner. So, effective communication is also supported by considering the following principle. First, entity-specific information is more useful than standardized descriptions. Second, the duplication of information in different parts of the financial statement is usually unnecessary and can make financial statements less understandable.
Okay, now I will explain further regarding cost of capital. There are two types of concept of capital. It is the financial and the physical concept. Generally, capital is anything that provides value or benefit to its owner. First, I will explain on the financial concept which capital is measured in invested money or invested purchasing power. The other one is physical capital, which capital regarded as the productive capacity of the entity based on units of outputs per day and is measured as operating capability. Moving on to concept of capital maintenance. First is financial capital maintenance. Profit is earned only if the financial or money amount of the net asset at the end of the period exceed the financial or money amount of the net asset at the beginning of the period after excluding any distribution to or any distribution from owners during the period. It can be measured in nominal monetary unit or in unit of constant purchasing power. It can be measured in nominal monetary units or in unit of constant purchasing power. Under physical capital maintenance, profit is earned only if the physical productive capacity or operating capability of the entity or the resources or funds needed to achieve that capacity at the end of the period exceed the physical productive capacity at the beginning of the period, after excluding any distribution to or any distribution from owners from the period. It can be measured in units of outputs per day.
There are currently many similarities between the MASB and IASB conceptual framework. Firstly, in particular, the overall objective of financial reporting under both conceptual framework are similar. Generally, the objective of financial reporting is to provide the useful information about the reporting entity to the existing and potential investor, creditor, lenders in making decisions on providing financial resource to the entity. Secondly, the kinds of financial statements to be prepared for a reporting period are similar under both conceptual framework. For example, the financial statement included statement of financial position and statement of profit or loss. The basic element consists in the financial statement are asset, liability and equity, which consists in the statement of financial position and statement of profit or loss. Thirdly, both Malaysia and international conceptual framework applying the same criteria in defining these basic elements. For example, asset is defined as an economic resource that controlled by the entity as a result of past events and able to generate economic benefit to the entity in the future. Meanwhile, the liability is defined as legally binding obligation that arising out of past or current course of action and transaction. Furthermore, the qualitative characteristics of useful financial information applied under each framework are identical. It includes two fundamental qualitative characteristics which are relevant and faithful representation, and four enhancing qualitative characteristics which are comparability, verifiability, timeliness, and understandability. Relevant required the financial information to be relevant to the need of economic decision making of the user. Faithful representation required the financial information to be true, fair, and free of misstatement. Comparability requires the financial statement to be comparable to the other financial information presented in the other accounting period. Verifiability required the financial information to be reasonably concluded by two independent accountants. Besides, timeliness requires the financial information to be timely and available to the user before relevant decision is made. Lastly, understandability requires the financial information to be clearly presented and readily understandable by the users. Last but not least, the underlying assumptions for financial reporting under both Malaysia and international conceptual framework are similar. It comprises of going concern and accrual accounting assumptions. Under both framework, the financial statement must be prepared on going concern basis. It is an assumption that an entity will continue operating in a foreseeable future and not plan to go into or to be forced to go into a liquidation. After that, accrual accounting is an accounting method that records revenue and expenses when they are incurred rather than when the cash is exchanged. For example, the credit sales is recorded in the book when the invoice is issued, regardless of whether the cash has been received. After that is about our findings in the article. The article is about the board has officially announced its amended framework, which take effect immediately and includes revisions that will drive IFRS in a new path. Three main issues in the finding, which are what changed, what are the challenges, and check the policy. What changed include board recent thinking of codified. The new framework is more comprehensive than the old one, with the goal of providing the board with a complete set of tools for creating standards. It has all aspects of standard setting from the financial reporting objective to presentation and disclosures. Next is the example of change. Some sensitive financial reporting issues, such as separation between liabilities and equity, were excluded from the new framework and being addressed in the other project. Besides, the second issue in the article is what are the challenges. The major modification to the framework's principle affect how and when asset and liability are recognized and derecognized in the financial statements. Some of the concepts in the new framework are completely new, such as the approach of liability based on practical ability. It is unknown what obstacle the board will have when employing them to establish standard in the future, because they have not been evaluated as part of any current standard setting process. So, it is unclear what obstacle financial statement preparer will face after new rules take effect. The last issue in the article is check the policies. The IASB used the conceptual framework largely to establish standard and to point the IFRS Interpretation Committee in interpreting them. It does not overrule particular IFRS standards, and any conflict with the new framework will be subject to common due process. This means that the overall impact on standard setting may take some time to resolve. Despite the fact that we believe this to be uncommon, some organizations may use the framework as a guide when deciding an accounting standards in the absence of the IFRS standards. So, the company should assess their policy in this situation and adopt the new guidance. That's all from us. Thank you for watching.